Thank you for joining us. Our presentation today features Tom Boyle, Portfolio Manager on Lazard's Emerging Markets Core Equity Team. Please note the information and opinions discussed do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change. With that, I'll turn it over to you, Tom.
Last year, emerging markets were largely dominated by trade war headlines, culminating with the long-awaited Phase 1 deal between China and the U.S. in January. While 2020 has started out with coronavirus fears impacting global growth and global markets, especially the Chinese market, it is important to note that emerging markets are more than just China and that we do not think this will have a lasting impact on the overall asset class. I think once these fears subside, it will give investors the opportunity to refocus on the fundamentals, which have significantly improved over the past few years. While trade tensions and the U.S. presidential election are likely to continue to influence the path of emerging market equities this year, we think there are several other stories that are getting lost in the fray. In this presentation, I will highlight 4 reasons why I'm optimistic about emerging markets in 2020 and discuss a few EM hotspots with a deep dive into the promising prospects in Brazil. The first reason for my optimism is a widening emerging market economic growth premium. Emerging market economies appear poised to grow more and grow faster than those in developed markets, offering investors access to growth at a time when the economic cycle in the U.S. in particular is getting into the late innings. Second, emerging market earnings are expected to pick up this year. Analysts project EM earnings to grow over 14% in 2020 versus about 10% for U.S. equities. We think the period of emerging market earnings declines dating back to mid-2017 seems to have bottomed in 2019 and should continue to support valuation levels in 2020. Third, the currency headwinds that put a strain on emerging market assets in 2019 seem poised to abate this year. Towards the end of last year, the U.S. dollar weakened as the Federal Reserve continued its easing cycle. Emerging market central banks, as a result, were able to implement more accommodative monetary policy actions to support their economies, and many currencies recovered. The Russian ruble, as an example, was up 12% for the year. While the U.S. dollar has strengthened recently over concerns over the coronavirus outbreak, we believe this could be temporary. In addition to relatively accommodative monetary policy from the Fed and a flatter U.S. yield curve, America's twin deficits are ballooning. The current account deficit accounts for 2.4% of GDP, and the budget deficit is 3.8% of GDP. However, there is a caveat here. If global growth deteriorates significantly, investors will likely look for safe havens, which could drive the U.S. dollar higher. And finally, even with a favorable earnings outlook compared to the developed markets, emerging market stocks are trading at about a 25% discount to the MSCI World and S&P 500 indices. Emerging market equities have been caught up in a risk-off sentiment due to trade and other factors. But if investors can look past those headlines and examine the fundamentals in 2020, another long-term rally could be in the offing. I often get the question, what are some of your hotspots or countries' economies you expect to perform well in the coming year or years? The 2 that come to mind immediately are Russia and Brazil. Russia had a blockbuster year, rallying more than 50% in 2019. Valuations for that market appear inexpensive, especially when you look at dividend yields. The MSCI Russia, for instance, yields around 7.9%, which is one of the highest in emerging markets and globally. We see the big increase in the payout ratio as one of the key drivers of the Russian rally of the last few years. Coming out of the global financial crisis, the payout ratio in Russia was as low as 15% and has now risen to 54%. This is significant as the increased payout ratio should be supportive of the robust dividend yield over the next few years, and more importantly, shows a firm commitment by managements to return cash to shareholders, which is a clear positive for the overall Russian market. The other hotspot, which we will go into in more detail, is Brazil. Brazil, which has the largest economy in South America, has been mired in government dysfunction, but has recently taken some important steps towards putting its economy on a path to more sustainable growth. Structural reforms like pension and tax reform, infrastructure investments in building, and privatizations of many poorly run state-owned enterprises should all help the country grow in a more productive and sustainable way, which will help foster growth in Brazil's lower and middle class, which suffered greatly in Brazil's economic downturn from 2014 to 2017. Once again, if this can happen, it will make for a much healthier economy and a more tantalizing prospect for long-term investors. What makes Brazil attractive? Brazil is among the 10 largest economies in the world, has more than 200 million consumers, has access to rich natural resources, and is a large producer and exporter of commodities, including the top soybean, coffee, and chicken exporter in the world. Brazil has taken the decisive first steps towards putting its economy on a path to sustainable growth. In October 2019, Brazil's Senate approved a landmark pension reform capping decades-long efforts. The reform, which lifted retirement ages by 9 years, may save up to $200 billion in the next decade, which will gradually reduce the country's debt-to-GDP dynamic, which is one of the worst in emerging markets. Pension reform was an important first step, but there is much more to be done. Government spending on entitlement programs and a disorganized civil service system have not only crowded out discretionary spending and infrastructure investment, it also places a heavy burden on Brazilian taxpayers who labor under some of the world's highest tax rates, not to mention cumbersome filing processes. According to a PwC survey, medium-sized businesses spend an average of 1,958 hours on tax preparation each year, compared to the United States, where they spend 175 hours. So what is being done? In 2020, Brazil's finance minister is working on a tax overhaul, which will lower the corporate tax rate, which could foster investment and job creation, and also simplify the overall tax system so that less is more, or that less time is needed for tax preparation and more time is spent on how to properly run and grow your business. The Senate and lower house of Brazil's Congress recently ended a deadlock that has been in place since September and agreed on parameters for a joint committee to debate tax reform. Unlike the market, we are cautiously optimistic that some sort of tax reform can get passed this year, which should be positive for Brazilian equities over the medium to long term. As I mentioned earlier, Brazil is home to some of the world's most resource-rich agricultural land with an ideal climate. The production, processing, and distribution of agricultural products account for 22% of Brazil's GDP, and in some areas of the country, this GDP contribution figure balloons to nearly 50%. Over the last 10 years, soybean and corn production has increased by 7% per annum, and Brazil's Minister of Agriculture expects 3% annual growth until 2027. More than 70% of its soybean production and 60% of its corn production are exported internationally, with China being one of its largest destinations. As we will see in the following charts, in order to be competitive, logistics and infrastructure, i.e. railroads, roads, and ports, are key. Poor infrastructure and transportation has been a serious impediment to growth in Brazil. As we can see in this chart, Brazil has been subject to some of the highest railroad tariffs in the world, which has hurt investment in this sector. In this chart, we compare the cost to produce and ship soybeans in Illinois versus Sorriso, Brazil. As you can see, to get 1 ton of soybeans to the port in Santos, it cost $120 versus $25 to get from Illinois to New Orleans. The shipping cost to China, once it gets to the port, is roughly the same, but obviously getting the product to the port is much lower in the U.S. So why is there such a difference? For one, the roads are poor and undeveloped in Brazil. In fact, many roads are uneven, unreliable, and sometimes even unpaved. With proper investment in transportation investment, these costs would recede, and in effect, Brazil will become much more competitive. In August, Brazil announced that it would privatize dozens of ports, airports, and railroads. In theory, privatizing or closing these money losers will greatly reduce the misallocation of capital. So far, they have successfully divested $28 billion, about $2 billion of which are in railways, ports, and airports. In addition, at the end of January at the World Economic Forum in Davos, Brazilian officials, including Paulo Guedes, the Minister of the Economy, met with investors to discuss the Investment Partnership Program, PPI, seeking $80 billion in investments for infrastructure projects. If Brazil can significantly increase its spending on infrastructure and privatize these mismanaged assets, then Brazil could improve its competitiveness, which would dramatically change Brazil's investment landscape. Fundamentals point to a strong year for emerging markets. Brazil is one country that is getting on the right path and could be a standout performer in the years to come. Structural reforms, infrastructure building, and encouraging the development of the middle class are all key to making the country a healthier economy and a more tantalizing prospect for long-term investors.